Over the weekend, leaders including the Speaker of the U.S. House of Representatives, Republican from Louisiana, Mike Johnson, and also U.S. Senate Majority Leader Chuck Schumer, a Democrat from the state of New York, each made separate announcements, but both said that an accord or an agreement had been reached for the funding of the federal government this year. This reports Chris Clow and HousingWire.com. Now, the details from both in the joint announcement by Schumer and Jeffries, and also a letter from colleagues from Mike Johnson, indicate that the deal was largely in line with a spending deal that had been reached between President Biden and former Speaker of the House Kevin McCarthy, Republican from California, and that was last spring. However, time is running out for both chambers to wrangle out a deal, and that is to pass the bills, reconcile them, and then get them to President Biden's desk for a signature to become law. Now, a partial government shutdown will take place on January 19th. That is this week if Congress cannot push through the agreement completely on the budget. Now, a government shutdown could present very unique challenges for the reverse mortgage industry, lenders and originators alike, especially in comparison to traditional mortgage business. Now, with no appropriations, the Federal Housing Administration, or FHA, would be unable to endorse new home equity conversion mortgage loans, or HECMs, for FHA insurance. Through other FHA loans would still be eligible for endorsement. So the HECM would be out in the cold. Although unlikely, a prolonged government shutdown could eventually cause issues that could disrupt new loan originations. For example, if a prolonged shutdown impacts liquidity in the mortgage business, lenders may be hesitant to close loans until the shutdown is resolved, said Understanding Reverse's Dan Hultquist. Any cuts or even par budgeting would be a challenge for Ginnie Mae, who has acquired the servicing of the now defunct reverse mortgage lender, Reverse Mortgage Funding's portfolio of HECM mortgage-backed securities. In fact, that agency has asked for increased funding as well to hire the needed personnel to service RMF's sizable portfolio. One of the nation's largest lenders, LoanDepot.com, confirmed last Monday that they are the latest industry victim of a cyber attack. Now, the incident has brought Loan Depot's systems down. The company shut down certain systems and continues to implement measures to secure its business operations, bring systems back online, and respond to the incident, said Loan Depot in an 8K filing with the SEC, or Securities and Exchange Commission. Now, that document mentions the date of the earliest cyber attack as reported as January 4th, 2023. The company also adds that they will continue to assess the impact of the incident. A spokesperson for LoanDepot.com directed HousingWire to the SEC filing for more details in the company's statement. Several large companies in the mortgage space have become targets of cyber attacks in recent months. Most recently, in October, Mr. Cooper exposed the data of nearly 15 million current and former clients in an incident which actually compromised the data of 32,000 reverse mortgage borrowers. What is loan servicing oversight and why is it important? To answer those questions, we bring you an exclusive interview recorded earlier last week with Reverse Market Insight CEO and founder John Lundy, and also their Director of Mortgage Servicing, Jared Skrabala. John, welcome. Thank you for joining us, and I see you have a colleague with you as well today.
Yeah, thanks, Shannon. I always appreciate the opportunity to chat with you and catch up a little bit. I'll introduce Jared here. Jared is he's been with us for a little over a year now, but Jared is one of the leaders on our servicing oversight side, has a really long history, and I'll let him elaborate a little bit more about, just the kind of experience and expertise he has in servicing oversight on the HECM product and proprietary products for a number of some of the biggest servicers in the space. But it's funny that you say you've never heard servicing oversight before, because I think when I started RMI with Topher way back in the day, we'd probably never heard the term either. I think a lot of people just focus on origination, and kind of once the loans are originated, it's kind of you kick it over the wall of the servicing and let them figure it out. Who knows? You just move on to the next loan. But obviously these loans stick around for, years and even decades. So there's a lot that happens on that back end in servicing. And frankly, servicing oversight is really about just optimizing and managing your portfolio, those loans and servicing rights that you have. There's a lot of opportunity, but there's also a lot of risk. There's potential losses that come down the pipe, all kinds of things that can happen, once it kind of goes over that proverbial wall into the servicing field. So I guess from there, Jared, I'll kick it over to you and let you talk a little bit about some of your experience and kind of how you got to this crazy world, and joining our team here.
Thank you, John. Jared, thanks for joining us.
Oh, thank you, Shannon, for having me. I appreciate it. So, I actually got my first taste in the reverse mortgage space back in 2008 when I joined Bank of America. I was actually in an underwriting role, so the fulfillment or origination side of things. And fortunately enough for me, I got exposure to the servicing oversight and servicing routines after they decided to exit the business in 2011 and 2012. I kind of transitioned into servicing for a short period of time while we were assisting with various MSR transfers and things of that nature. And then they did retain a small portfolio, just things that couldn't be included in the various sales. So really my start to servicing oversight was around 2012. So I've been doing this for roughly 12 years, and I find it intriguing. I've learned a lot over the last 12 years, and really just understanding the from the front end to the back end has really helped me just shape who I've become in terms of my skill set. So yeah, it's been an incredible experience so far.
So, what are some of the ways you can mitigate risk in a servicing portfolio? Because you've mentioned that there are risks inherent in having a loan servicing portfolio. What are some of the risks you address?
There's a lot of different risks. I mean, when we're talking about FHA insured mortgages, the one key term that a lot of industry participants focus on is debenture interest curtailment, and that comes about once a loan goes into default. So ensuring that timelines are met is really critical. And I think the industry as a whole has become a lot more aware. There's been enhancements to technology that has kind of helped with the monitoring and tracking of that. But there's nuances to all these things, and just interpretations of HUD guidelines, making sure you're kind of following these loans as they progress through those various stages. The other thing that you'll hear often is appraisal-based claim risk, and really that comes about when the REO stage, when you're looking to dispose of the REO, you want to control that. And these are terms that are used widely, especially when evaluating portfolios and pricing them. And it's really the oversight is focused on trying to prevent those things. It's really focusing on a lot of the ancillary processes that are involved to kind of prevent that. So it really doesn't do you any good if you catch these things later in the process when they've already occurred. It's preventing them. So it's really having control of your data and having organized data sets, and being able to identify where these things might come about. Like, so I use an example with the appraisal-based claim risk. The idea of that is that you once you have an REO, you have to sell it within 6 months of acquiring what they call marketable title, so taking possession of it essentially. And you might have a situation where the property, once you acquire it, it's filled with belongings, right? You need to get that in condition so a realtor can list it and conduct showings, and it's got stuff in it that's accumulated through the borrower's lifetime, right? And so a vendor will go out and give you a quote on how much it'll cost to have that stuff removed, and then they come out and they remove it. Well, what happens if there's a delay in removing the belongings of that that party in order to get this thing listed and in condition so you can sell it. What do you do at that point? So like we would go in and we would look at, okay, well, why is this taking so long? Identify those delays before it becomes a problem and before we've missed a critical timeline where it's costing the client losses. I mean, that's just one example of what we would deploy through our tools and monitoring and just organized data sets that will allow us to identify these things as they're happening in real time and put the client in best position to address it, or give a servicing level directive to their vendor or their subservicer so they're able to avoid those mitigate those losses that can be mitigated.
So who, when you're doing servicing oversight, who do you, with the lender or servicer, who are you interfacing with? If it's the lender, what position or title, or with the servicer? Where does that interaction take place?
I'll just touch on it really quickly. So I think, in the way the industry is currently set up, a lot of particularly HECM loans, they end up in HMBS portfolios. So the HMBS issuer is one of the really important, folks. That's typically who we'll end up contracting with. But then it really is about coordinating with not just the issuer themselves, but also some of their key vendors, subservicer, some of their REO vendors, things like that. So, Jared, I know there's a lot more detail we can add in there if you want to chime in.
Yeah, I think you touched on the critical pieces there, just the interaction with the issuer and the master servicer, and then also the subservicer. Subservicer is doing the day-to-day servicing the loan. They're going to follow HUD guidelines and they're going to service that in accordance with those. But there's a lot of things that come up that require decision making that might fall. It might not be clear as to what is required or what needs to do. And even though you're following HUD guidelines, sometimes that's not always what's best for the issuer, the parties that hold the financial interest. You might be better suited to make a decision that might be slightly outside of HUD guidelines in terms of protecting yourself against curtailment and things of that nature, where you're going to maximize the return on that and avoid a loss altogether. So there's decisions that come up throughout the course of the life of the loan that you have to kind of evaluate and take in with the data set that you have, but also making the best decision possible for the client.
Servicing oversight, has it become increasingly important because of market conditions that maybe the average originator or broker is not aware of?
Yeah, I would say that. I'd say market conditions, I think, as all these participants and interested parties become involved, I mean, you're talking about financiers, like they're all interested in who's overseeing this. They don't want to depend on one party to be responsible for everything, and kind of blindly agree to just whatever one party is telling you. They want to look at it and say, okay, do we have checks and balances in place? Do we have controls in place where we have monitoring of the party that's doing the work, and making sure that they're following through with what they're contracted to do? But also, again, kind of circling back to the importance of just having servicing level directives. So if you're not giving directives on what you want them to do, they're not going to do it. Right. So there's cases where that might come up where it's a little bit outside the box. And that's one of the things that the benefits to having a proper oversight program in place will do for you.
Well, Jared, John, gentlemen, thank you so much for not only educating me, but our listeners and viewers. And that concludes another episode of HECMWorld Weekly, the nation's only weekly podcast, bringing you the most recent reverse mortgage news for you, the mortgage professional. Don't forget, you can subscribe and listen to this podcast on Apple Music, Spotify, or Podbean.com, and listen as well here at HECMWorld.com. We look forward to having you come back next week for the reverse mortgage news that's curated just for you. Have a great week.